You know that gold trade this week. How did you know that that was going to smash through the fib and then reach the 1800 order block? I know there, obviously, those levels are. You expect them to go to those levels, but was there any
Yeah.
reason it would go through the fib?
Obviously it depends on which time frame you've drawn the fib, because in the Zoom I think I said you can either draw it from one candle or the whole imbalance range. And say you're on the 4 hour here, and you let me just get rid of this line, and you were drawing the imbalance like this, the fib even like this. Let's put the 7, that one on. So you see it came into it and then went down. But I was personally looking for 1800 because if you see back here, all this liquidity was in like that source of that 1800, 1799 area. And this drop was because of, I think, wait, was that the NFP one? Yeah, this was the NFP drop. So all of this imbalance here had to be filled. All of this. Obviously, this one came up pretty much straight away. So you could have, you could have caught a nice sell down there. And then we did slowly all of last week. Markets were so slow, because on Sunday we had that massive drop from here all the way down, all this manipulation down here. I expected price to come back to this 1800 level because when there's consolidation like this, liquidity, it always comes back to test it. It's kind of like a normal support and resistance break retest. But you do have that 1800 psychological level. You have the imbalance here. And if we go on to the 1 hour, you see here as well. If we just change the color of this, we do also have that 1 hour order block, which if you see, let's remove this area here. If you draw it, press control, it locks on. Perfect entry here. Or the top of the order block lined up perfectly with pretty much 1800. So there's a lot of confluences looking at 1800. You could have got entry on, any of these wicks here. If you're being safe, you could have had stops above this order block or like, I don't know, 50%. But I was personally waiting for 1800, especially with gold. These levels act as key levels. If we look back, maybe we could find an example of it. It happens a lot in GA, these psychological levels. We just get rid of this. Yeah, like here, this 1.8 level, 1.88, you see this whole area was rejecting the 1.8 area. On the higher time frames, you can probably see, yeah, if you draw a line like a box here, wherever it starts. So this area, this is where price reversed from. And then if we go back on the 4 hour, maybe 1.83, price usually reverses at these sort of levels. It's like the banks are taking profit at these levels, or most of the orders are at these levels. So that's where, so say you were in gold, say you were in gold buys down here, places you could target, 1750, 1800 or 1775. I say every 250 pips on gold has one of these levels, every 100 pips on GA, so 1.88 to 1.89, 100 pips, that's one of the key levels. So on gold, I'd say you could have like 1710, 1720, but I say it's like the quarters on gold. So every 1,000 pips, you have like 4 zones in between. So you have the 1750, which as you see this one, dropped down below 1700, came back up 1750, then we reversed, back down, and where did we bounce off? 1725, to the pip pretty much. All these candles closed above 1725, and here 1750 back down to 1725, and then back up again. And where did we come back to retest? Back to 1750 pretty much. So that's one of the reasons I was looking for 1800. We did have obviously that fib pretty much. came back in. And remember I said in the Zoom, if it closes above, it can come back down, and then it retested it again. So you could have got a sell on this wick up here. If we go down, you probably could see a better example. So look, if you trade order blocks, this was a weird one because the 1 hour order block lined up with the 4 hour golden zone pretty much. So that's why we didn't get a nice close below. So if you were just looking for fibs, you wouldn't have got the close below for your entry. But if you're using order blocks as well on like a lower time frame, as another confluence, and I had that marked out, and we had 1, 2, 3, 4, 5, 6. Six. You could count these two as well, like 6 to 8 taps in this order block area, which also is technically holding this golden zone fib area. And then say you didn't count this as the fib, came down. What did I say? It could come back and retest it again. 2 taps of this came down. You missed that. 1, 2, 3, 3 taps of the 61. And, you could have caught, how many pips is this? You could have caught almost 100 pips just from getting the re-entry, even if you missed it. From up here, how many pips, if it's going to let me. 150 pips, could have caught from that. And with gold, I like to use only a 30 pip stop most of the time, unless obviously maybe we have some news or something like that. I might widen it for the news and then move it back. But a lot of the time it's either 30 pip stops or, sometimes I use no stops because sometimes you got to let the trade breathe a little bit. But I'd say definitely 30, 40 pips maybe. But I'd say never go get above 50 or 60 pip stops, especially on gold, because if it goes 50 or 60 pips against you, then, would you rather be out of 30 pips and your trade be wrong, or would you rather be out at 60 pips? Say it's out at 30 pips, you could reevaluate and maybe get into like a buy maybe if you got the sales wrong. So I think 60 pips, I see a lot of people use on gold because obviously the volatility, they're using the higher time frames. But yeah, you only need 30 pip stops on this trade. And that's why I was looking to enter at 1800 and stops at around 1803. You see it was above all these 3 wicks here, which caused this move down. So you would have had stops around there. And these imbalance candles, they're pretty much, I wouldn't count them as imbalance really. I say when you're looking for an imbalance candle to trade from, you want ones like these. So this was an imbalance here, filled most of it, came down, filled all of the imbalance. And what did it do? It created an imbalance, which was immediately filled by another imbalance. So it filled this imbalance, created another imbalance, and then filled the other imbalance by creating another imbalance. So these big candles are the ones you're looking for, not something like, let me look at an example. Something like this, really. I wouldn't trade solely off a candle just like this because it hasn't really been filled much. You want to be looking for like these candles like this candle, this candle. You see the big ones? You could say they're pretty much engulfing candles, but a lot of the time it does change market direction by like hundreds of pips. And this is where you can enter on the pullbacks of these candles. The pullback sold down, as we had here, big drop. And this whole area is an imbalance. It's not just one candle. It's not just, you wouldn't count this as the pullback and then a drop. This whole area is imbalance. So if we go on maybe the 8 hour, you can see that they're all imbalance. So this whole area here is the imbalance. So this whole area has to be filled. It's not like here or here where you have 1 candle, 2 candles, gets filled instantly. This took from the 9th to 17th. So 8 days to fill this imbalance. And especially when it happened like this, a lot of manipulation. Sunday night, we had the open. You could expect the market the same week to correct the move it had. And that's what we saw. Corrected it pretty much instantly. We had the Monday and Tuesday were just consolidating. That's what usually happens after a move like that. So if you get a big move on gold, the next day will probably not move much at all. Maybe it starts pulling back a little bit, but then usually the second day after, that's when I'll look to maybe get a continuation trade. So if you get the pullback, you look for the continuation to downside, like you had here, came down, came back up the pullback. And this is another example of the fib working perfectly if you go on the higher time frames. So tap in the order block, 2 taps on the fib, you're selling, you're in profit, lovely times. But with the fib, you can also use it as an immediate pullback. This one here could have acted as that. If we go down, so if we zoom in on this one, this is an example of an immediate pullback one. I said the 32 before, and that is a good one to use. As you see, this first wick here did tap into the 32 as well. So you could have got an entry here, you could have got an entry here, an entry here. But I would have been a bit careful entering sells based off of this here, especially when we had, a 700 pip imbalance area. I wouldn't have entered just on a little pullback like that, although it would have worked and you would have been a little bit in profit. What's that, like 250 pips? It's just not really wise putting your stop loss. Say you entered down here, you would have had your stops above the imbalance area, and that's 155 pip stops, unless you want to scale right down to lower timeframes in this area. We'll see what that looks like. I don't really go lower than the 30 or the 15. So yeah, you could have got a nice entry here, but still your stop loss, you got to be careful because you have order block here and then you have imbalance. So price could easily come up back to this area here, like this, and then drop, or fill maybe this imbalance candle, then drop. So say you had your stops just above that wick, maybe you would have been stopped out if this happened. So I definitely wouldn't enter if it was a situation like this, but you really don't know until it happens because every situation is different. And especially what we had today, there's a lot of uncertainty in this area. And then this wick up here, we had the manipulation from the news event. I think maybe it was I can't even remember what the news was, but yeah, that caused a little spike up, also tapping the fib again, and then a drop. So that's why I was looking at that trade. It was quite simple. If you use the stuff I've showed you already, I think in the last stream I went over a trade where we used the order blocks as well. If we go on the 1 hour. Yeah, I think this one I was talking about, or yeah, this one here. This is the trade I was talking about with the example of the order block instead of the fib. And it also created a nice double top for liquidity. And what did price do up here? So there's obviously money up here. And price came out, grabbed the money, came back down. But what does price have to do when it's created liquidity? New liquidity up here. Has to come back to test it. And then we had that there. We had the order block, and then we created that nice imbalance candle. So those are quite easy sells using the order block instead of the fib. Because I know a lot of people were saying, why am I missing these trades? Because it hasn't come to the fib. And you can't just trade using a fib because the fib is literally just for the entries. You've got to have the idea of the market direction. So like this, when price is moving down this much, we're clearly looking for sales. You wouldn't look for buys when the market has been in, how big is this drop? So since the last high, we've had 1,500-ish pips drop. So there's not really any reason to be looking for buys when price is bearish as it is. I look for direction usually on the 4 hour, the 1 hour, maybe if you're just doing like an intraday scalp. But on gold, you definitely want to look on higher time frames. Say you go on like the 30-minute, 15-minute, you could make out that this is bullish. You could have entered on, any of these pullbacks for buys. And then when price breaks that trend, you're then getting stopped out. Or you're looking for another entry, but then price will just continue to the downside. You could have drawn a fib like that, you got the 32. But a lot of people, they draw the fibs like this, they usually have the 50% on, they're getting tagged in for buys now, but price has already come up to our level. We're in sales here. They're buying. We're targeting their stop losses. We're targeting the 99% of traders' stop losses. That's pretty much the strategy that we use. So I hope the gold breakdown made sense. Does anyone understand why I was looking to short out that area?
Yeah, I understand that. Do you think, are you still looking for it to come back to the 1800 area, or will it just keep moving down now?
Because it's filled pretty much like
Most of it,
80% of this area, we could see a bigger drop now. But because all that liquidity at that area, you could say it's been filled. If we look at this wick here, came down. If you're looking at fair value gaps, which is different to imbalance, I think someone mentioned that, which is from like the wick to the wick sort of thing. It's pretty much been filled. So, it could come back to 1800 and that'd be good. Could get a nicer entry. But I do think it could drop off a little bit first, depending on obviously the dollar strength this week, especially with what's happening. Like the wars affect gold a lot. It happened last year as well. You just got to watch out, because I don't usually look at the news for like the fundamentals when I'm trading, but you can have like flash crashes. So it's kind of like what happened here. Price will literally move with gold anyway, hundreds of pips in seconds, and then just reverse. And that's when like something happens. I remember it happened with some vaccine news last year. It had like 1,000 pip drop in a few hours. Yeah, I think that was this one here, maybe. Yeah, we dropped 1,000 pips in pretty much 2 days, 3 days, from a vaccine news. And this one candle here, technically down to the bottom, 850 pip candle on gold based off of some vaccine news. So you obviously got to watch out for stuff like that, but you can't really predict it. You don't know when an announcement's going to come out. So price could, dollar could fall tomorrow, gold could go back to 1900. But technical analysis, I think we could drop further from here if we don't test 1900, of course. But yeah, any other questions before I show you some examples?
That's it from me.
I'm good.
I remember someone said they had a question to ask. I can't remember. I don't know if they're on here or not. Let me have a look in the chat. Yeah, it was mostly about the order blocks. Okay, so I was looking, I can't remember which pair it was, it might have been gold. I was looking back at doing some back testing. I think someone asked about showing back testing. And I'd say the best way to back test on gold, don't go too far back, because then you can't scale down for entries. Because say you go back on the 4 hour, you're stuck then on the 4 hour and the 1 hour. Maybe go back to like, a few months ago or something. You can use the replay tool, but yeah, let's go back to around here. So what we have, obviously a massive drop. So we're looking for price to, come back up. We've got this big imbalance area here. If we draw it like that, this is technically the order block. If we go on the daily, we might be able to see it. Yeah, so you could say any of these areas here. You could say that little area there's the order block. Then we've created that imbalance candle. Oh, yeah. So we're obviously looking for price to fill this imbalance. It's kind of the same situation we had this week. You had that big drop. You had 1 or 2 candles coming back up, then another big drop. And if we play price on, we'll go over this later, but I can see a pattern forming here. Does anyone know what this is forming right now?
Is it just forming liquidity?
Is it just
What did you say, Josh?
just a period of consolidation?
But what happens during consolidation after a drop like this? Why is it consolidating?
Is it building liquidity?
Yeah, it's building the orders and liquidity to gain the strength to move higher. So if we draw a line here, let's say like this. So this is the areas. So we have this area of liquidity here, which was taken down there. So now we're looking for price to take liquidity down here. So then we can look for an entry. You could say there's also liquidity above this area here as well. So, but price will usually take liquidity to the downside before moving to the upside. I think I mentioned this before. So what price will do, it'll consolidate in this area. It will then, the banks will move it lower to get their client in at a cheaper price before they're moving it to the upside. And obviously our first, well, not our first target, but one target would be this 1850 area. You could say, if we draw the fib on here, where because you look to target, you could say 50% of this imbalance area. Let's say that's another target. But you could target anywhere in this area here for longer term. This is where you could maybe look to sell off. So if we see how this plays out, you see consolidation. There we had the break below, created liquidity. Oh, no, sorry, grabbed the liquidity which was created here. So then what does price do? It comes back up, tests the liquidity. Because remember I said lower time frame, this will be consolidation. Down in this area, price broke it, came back to test it before then moving higher. Also, this is accumulation, which is forming. So Wyckoff, which is hard to explain, and I'll have to do like a separate zoom on accumulation, distribution, reaccumulation. But ideally, what you do is enter right here. So you've identified the Wyckoff, you had the spring, the test. This will make more sense soon, trust me. But you can see it as liquidity created. We then grabbed the liquidity, tested the liquidity, and then for a move higher. Could have entered here, or maybe wait for a retest, pullback on this imbalance candle here. So if we look here, stops, remember I said 30 pips usually. You could have had them like that. You probably could have scaled down lower and gotten a better entry, maybe down on one of these wicks. And then remember the target was up here, this area. So, 1 to 25, very, very good risk reward. And you only need one trade like this per month or per week. So you're doing it on a lower time frame. So if we look, and it's also a lot easier with other pairs because gold, you have to have like 20, 30, 40 pip stops because obviously it moves so much. But if we look, price came down, and let me see if we could have got that immediate fib entry. So yeah, look, where did it come to? To the T, wick, wick, boom, reversal. So if you followed that immediate pullback entry, you could have got another entry here. Where could you have put your stops? Again, you would have had a lower risk to reward on this one. You still would have got the nice re-entry, still targeting the same area. What you can do is maybe make one risk-free. And then look, remember I said, price always comes back to test the liquidity once it's broken it, came back, tested it. And then hopefully we get a push higher now. So you see again, consolidation, another tap down to this level. Again, pretty much to the pip. And then we're approaching the fib level now. So if we look, where did price come to? Let's play it on. There. Pretty much came to the 50% before dropping down. And that's where we are at now. So, from this trade, you probably would have taken partials. Well, I hope you would have taken partials when you're 750 pips in profit. But this is how I do my backtesting. So instead of just looking on like the 15-minute and doing it like that, if you backtest on the higher time frames and catch these big moves, you'll be a lot better at trading on the lower time frames. Because I personally think it's a lot harder on the higher time frames for people that are starting. Firstly, they are a lot less predictable because the lower time frames, say this move here, you could have had buys, you could have bought here, maybe you could have tapped an order block on the over here and sold down. And each one of these little candles It's not little at all. You know, this one, 100 pips, that one down candle. In the grand schemes of the whole move, would you rather be catching a 50 pip or 100 pip candle? Would you rather catch a 1 to 25 with a scale in, which is a 1 to 10, and then you could be done for the month? You know, you're up 35% on 2 trades. All you've had to do is do your analysis. You know, at the end of this mentorship, you'll be able to do this in 30 minutes, 20 minutes, even 10 minutes, whatever, depending on how much work you put in. If you have to do your markup for the week, maybe on a Sunday, set your alerts, maybe set your sell limits, your buy limits for these sort of areas, set your trades, and then you can go off MT4, go live your life, go live the so-called Forex lifestyle, and, you know, then you're sorted. But then if you're just sat here, if we go back to, let's go back to here. Let's go on a 15-minute. A lot of people use 15 minutes. Yeah, so if we go back here, a lot of people, they see, oh, we got an order block here. They sell when it taps in. They go down here. Maybe they'd see price come back up. Oh, we tapped in order block. They start selling again. Then they're targeting the wicks down here. Oh, they get stopped out. So now, instead of making 4% profit and then holding for a big move, they made 4%. They've lost 1%. Maybe they're looking to get another re-entry. Oh, they've lost another trade. They're down 2%. If you wait for these big moves, you're just going to catch, firstly, way more pips and a lot of scaling opportunities. So when you're in these long trades, you're obviously holding for a long time. So it does test your psychology a lot, especially with a pair like gold. Let's say you're in profit up here and then you have, you know, a 200 pip drop, your profit will obviously move a lot. So that's why I say close MT4 when you're in your trades, because say you have it open, you know, you're checking the charts, especially if you trade full time. This is what I was doing when I started. You just check the charts all the time because you've got nothing else to do. You're just sat there at your desk. You just have the charts open. You're just like, oh, I need to enter a trade. I need to enter a trade. Where can I look to enter? And instead of just waiting for the setup to come to you, you start forcing trades. You think, oh, maybe if I check another pair that I haven't traded before to look for an entry, you're just gonna firstly lose more because the more you enter, the more chance you have to lose. Whereas if you wait for the perfect setup, like we had here, so from the 17th of June to the 30th of June, you know, that 13 days here was building up for this big move. If you catch a big move, you could take a month off. You know, if you're doing 100K FTMO, let's say, this trade here, 35%, you're up 35 grand on one trade, on one move. And the more you learn and practice catching the whole move rather than catching every trade, you'll make a hell of a lot more money. When I stopped focusing on catching every single drop, every single push up, then I started focusing on the higher time frames. And actually, instead of trading every single day, trading 1 or 2 trades a week, 3 trades a week maybe, I started winning a lot more trades. My win rate went up. And if we actually look here, I'll just show you quickly what this strategy can do. So I started this funding talent account for a YouTube series, you know, a 25K one. Look at the win rate. 7.5% profit, 100% win rate. So if we look at trades, all profit. And that's literally just that's in 30 days. 1, 2, 3, 4, 5, 6. 6 trades in 30 days. That's one every 5 days. One trade every 5 days. But you see, if you were entering, maybe, I know a lot of traders enter 1 or 2 a day. That's 10 trades in a week. In a month, what's that? 40 trades in a month. Say you have a 50% win rate, you're losing 20 trades in a month. But if you wait for a perfect setup like this, you know, you've waited 13 days. In those 13 days, they've entered 26 trades. But they might be down. Because if you have a 50% win rate, you could win 50 in a row, then lose 50 in a row. If you have an 85% win rate, you could lose 15 trades in a row. So it's just about how you handle those losses. But with this strategy, if you look at the bigger picture, as I've showed here, even if you miss this wick entry down here, what I taught you, the immediate pullback after the imbalance to the pip, you could have caught 10%, which is 647 pips. And you could have got re-entries, broke, retested the liquidity. And let's say you got an entry on this liquidity here, stops, just, you could have them just below this little imbalance here, 40 pips. If we look, and then, yeah, TP would have been here. And that's another almost 10% profit just from a little scale in. So focus on higher time frames, catching the move instead of each little micro move, you could say, especially on different pairs. If you're trading a pair like GA, all these little moves you could catch. But if you're looking at the bigger picture, you'd be buying down here, holding all the way up to maybe an imbalance from back here, an order block from back here on the daily. And quickly, I'll show a little tip that especially works on GA, something called the QML. It's kind of like a head and shoulders, but it's a head and shoulders that traps the retail traders. So like an institutional head and shoulders, you could say. It's hard to find on a high time frame like this, but let me find one. When was this? January. Let's go on to 1 hour. Let's find the QML for you. Actually, let's just go on gold because I know somewhere's a good example. If we go back, yeah, down here, let's put the replay on. So yeah, but with all the strategies I teach you, just literally go on the replay mode, just go back and test it before live trading it. Because you obviously want to get a good idea of the strategy before you start trading it live. When you're getting more confident, then you can go on to a live account. If we play this on, I think this is where the QML was formed. Around this area, I'm pretty sure. Oh yeah, here. So if we go back, retail, what would you normally be seeing here? You'd have the shoulder, the head, but they wait for, oh wait, no. They'd be looking, yeah, like that, like that, like that, and then they'd be buying here to look for price to come up. But what we're looking for is price to create a higher high. So what they want is this neckline to hold. What we're looking for is price to pretty much do this. Like that. So we want price to create that higher high to then test the shoulder again and then move to the upside. But what they look for is this. And then maybe they wait for a pullback to this level to then look to buy. So we get an entry on the shoulder, they get an entry on the pullback. This could even make their head and shoulders invalid because now the neckline hasn't held. So why would they look for a retest of the neckline if it didn't hold? So the example here, if we just remove this, we've got price come up, or I come down even, to create the left shoulder. We come down, created the head, came up, the higher high here, and that's created the broken the neckline even. And what we're now looking for, price to come down into this right shoulder. Instead of waiting for a pullback of the neckline, we're entering on this shoulder here. And with this, I'd say a lot of the times it does work with the fib. So this push up here will normally create an imbalance. And then what will it leave behind? An order block here. So oh wait, I mean to play that on. But we've created an order block here as well. So we changed the color of that. Yeah, so we got order block in red. We've got the QML where we're looking to buy from here. Set a buy limit in this area. Stops, you can have them, you could say 30 pips. Tapped in the order block, tapped in the QML. say we're drawing a fib from this imbalance to this imbalance here, tapped in the fib, there are confluences. Where would we target? A lot of people say with the QML to target the higher high. If you targeted there, you've got 111 pips, you've got 1 to 3.89. Where else could you target? You could target this liquidity area here, lower time frame liquidity in this area, and would have been hit to the T. And then what did price do? It then reversed. So with this, add it to your trading. It's another entry confluence. Instead of waiting for just a fib, just an order block, use this as well. So it's a good reversal pattern, and it only should be used for reversals. You wouldn't see this. So say you're in a downtrend, you wouldn't see it to continue a downtrend. You'd look for it to then reverse price. So if you're in a downtrend, you'd look for this to start buying, and in the uptrend, look for it to start selling. So what do we do here? We caught the buys when we're in a downtrend. So that's a good thing to add, but make sure you don't miss it, because a lot of times with the QML, it can come down, test it, wick into it, and then reverse. So you have got to be quick on the charts. And what I'd do is maybe just set an alert just before price gets to this area. Can't set on a replay, but before price gets to this area, so you don't miss the trade. Because say you're waiting for one of these big trades, but then you don't have an alert set, you're not at the charts. What you're going to do, you're going to miss that big opportunity. So make sure to set alerts or sell limits, buy orders, or buy stops even, so you do not miss out on these trades. And for targets, because I know a lot of people don't know where to target either imbalance fills. So you're buying here, where to target imbalance fill, another target order block, and maybe got the fib there as well. Perfect sell. So you got the liquidity to target, you got the imbalance, you've got order blocks, you could target a fib area, you could buy to sell. So say you're looking for price to come up to 1800, you could buy up to 1800, close your buys, sell down to your original target. Because if you're waiting for price to get to a certain area, why not trade to that certain area? Obviously, if you get the right confluences, then you might as well double your profit. But do be careful when you're doing that, because a lot of times you can miss it. Like say you were buying to 1800 today, you would have missed it, and then price would have just melted, hit your stop loss. But yeah, I hope this did help. It wasn't really a topic one, because a lot of people did have questions, and I hope this did help. But we'll do another one this week as well, where I'll go over more on order blocks, liquidity, and next week we'll start on Wyckoff and teaching that, because that is a longer topic to actually do. If we look here, we could have got this gold entry here as well on that immediate pullback. But yeah, hope you did enjoy this and learn something, and I'll keep you up to date when the next Zoom is, and make sure to ask questions as well in the Discord, and I can answer them, and also any Zoom topics which you want. So yeah, we'll be recorded and uploaded, and I'll see you later this week for the next one.
Cheers.
Nice one. See ya.